Hello, everyone. I am so excited to have you here today. We're really excited to be able to share some information with you today, and today we're going to be focusing on this crazy question: Can I beat the stock market with impact crowdfunding investments? And I know it seems, I don't know, crazy, difficult, maybe not even relevant. But here's the thing. If you were confident, if you had proven to yourself by doing it that you could make more money by investing in social impact than you could make in the stock market, wouldn't you be inclined to move at least some of the money from your stock market investments into social impact via crowdfunding? I think you would. I think you would. So that's why this is an important topic. So stick around. We're going to have a great conversation today. Let me see if I can get my screen share going here. We are really excited to have you, and thank you very much for joining us today. I am going to take questions at the end. I'll deal with all the questions then, but I invite you to submit them at any point during the conversation today as we talk, using the Q&A function in the Zoom. So if you hover your mouse over the Zoom screen, or my face, or over my screen share, you'll see the Q&A button on the bottom of the screen pop up. So I want to acknowledge and thank Purpose Rounds for their tremendous support for our work. We're grateful for their sponsorship. I want to acknowledge and thank Halyard Compliance for their support and sponsorship for our work and for these webinars that are so important, I think, for the community as we seek to help people do crowdfunding better, both as investors and raising capital. We're grateful for their support. We're grateful also for Rotary, Move the Needle with Rob Kaplan, and Amoeba, Funding Hope, and Ridgecrest Herbals for their support. We're also grateful to the Crowdfunding Professionals Association, the GIG Group, the Casson Group, Dakin Capital, Community Vision Solutions, Crowdfund Main Street, and CrowdMax for their tremendous support of our work. I want to acknowledge and thank Chandan Saha, my colleague. Chandan he's just a rock star behind the scenes. He does so much work for us and is himself becoming a genuine expert on crowdfunding and social impact. And I'm grateful for the partnership that we've created over the decade that we've worked together. I want to just remind everyone, today I'm sharing information. It's financial. We're talking about money. And when we talk about this, it's important for you to put this in context. I'm educating you. I'm providing you valuable information that I hope will be helpful to you in how you manage your money. But your investment decisions are yours. And if you need investment advice or want investment advice as you make investments, you need to get that from somebody else. And if you would like some recommendations for people who can help you manage your money with a crowdfunding investment idea in mind, I have some names and can introduce you to some of the great folks who are doing that work. We have some rewards in place. And so if you are watching via YouTube, and many of you probably are watching via YouTube, if this is live when you're watching and not the recording, you can join us in the Zoom room. And to do that, I invite you to visit 4sc.fund/September. I'll just visit 4sc.fund. Visit 4sc.fund and then click on the links, follow the links there until you find the for the event today, and then pop into the Zoom. And then we'll track your attendance. If you attend 10 times, we'll give you $100. We're building a movement to really change the world. And to do this, we need you to get involved. If you are interested in being a really active impact crowdfunding investor, and I hope you are, I invite you to consider joining the Impact Cherub Club. Visit impactshare.com to learn more. And we meet on the third Tuesdays of each month at 1 p.m. Eastern. And we just have a lot of fun sharing the burden and sharing the fun to decide what to invest in each month. And over the course of the last 36 months or 34 months that we've been doing this, something like that, we've made dozens and dozens of investments. We're having real impact and making money. So I invite you to check it out and join us. I've written a book on this topic, How to Make Money with Impact Crowdfunding. And you can get the ebook free. So if you would like that and don't have it yet, visit 4sc.fund/ebook free, 4sc.fund, and you can get that book or scan that QR code while I've got it up. I had a lot of fun writing this. I really wanted this to be a long-term valuable resource. And so I collaborated with a lot of people, had a lot of great help on this project. And so this reflects my best insights, but really checked by a lot of smart people who thoughtfully reviewed the book and gave me suggestions to improve it. So this is really a helpful guide. I encourage you to check it out. I want to tell you a little bit about myself, and I'm known primarily these days as a show host, right? And as an event convener. And so I sometimes feel like I need to remind folks that I came at this work honestly, right? I'm an old finance guy. I owned and led an SEC registered FINRA member investment banking firm that helped companies do things like raise venture capital, do mergers and acquisitions, et cetera, et cetera. I was the CFO of the third largest company on the Inc. 500 list one year. I was the treasurer of a global food and beverage company, a public food company, traveled all around the world doing business in that role. I'm a best-selling author, 7 books now under my belt. You've seen the most recent, done 1,500 episodes of my show, and I'm the CEO of the SuperCrowd Inc., which, by the way, has done its own crowdfunding campaign to raise capital. I bring a depth of experience, and I'm happy to have that opportunity to share a little bit with you today. Today, you're going to learn, we're going to set a benchmark first, right? What the stock market actually yields. And it's tempting to think about the stock market returns in rose-colored glasses sometimes. We remember our wins and we forget our losses and think of the market as being the great bestower of wealth. We'll explore that a little bit. And then I'm going to provide you with 3 different strategies, all of which have the ability, if done well, to deliver higher returns than the stock market. And so we'll talk about those 3 today. So I hope you'll stick around. This is going to be, I hope, really truly helpful information for you. The highest return ever achieved in the stock market was actually during the Great Depression back in 1930, June 32 to June 33. In one 12-month period, the stock market rose 162%. It more than doubled in 1 year. I want to put that into a little bit of context, though. It doubled after it had dropped 89%, virtually 90%, right? Can you imagine having a dollar in 1929 and waking up in 1932 with 11 cents? That would be mind-blowing. Yes, that 11 cents became 25 cents by June of 1933. It was, oh my gosh, what a painful time. But it's a great reminder that we sometimes look at the stock market like it's going to deliver this kind of return. But it's been almost 100 years since we had a return like that, and it was only after losing nearly 90% of the value. The worst 12-month period for the stock market was during this time period, right? From September 1930 to September 31, the stock market dropped in that 12-month period 67%. It dropped nearly 90% from 29 top to 32 bottom. But stock market troubles are not just a thing of the deep past. Let's be clear. We don't have to go back any farther than 2007. And I suspect that if you're watching this, you were alive in 2007 and can remember this. But the S&P over an 18-month period lost 56.8%. And the shocking thing is that in a 6-month period from the fall of 2008 to the spring of 2009, the stock market in just that 6-month period lost 47% of its value. Can you imagine? I lived it, right? I remember watching my portfolio just slowly evaporate. It was a scary, frustrating time. And investors capitulated during that time, very much like the Great Depression. So let's be clear. The stock market does trend to go up. And there are some very good years, 162% back in 32, 33, right? But that good year is not what you should expect. You shouldn't expect the stock market to double every year. We sometimes get in our minds that stocks can and should do that. It's rare. It's rare. There are exceptions, right? We talk about Tesla, and some of us remember being able to buy Tesla shares at a fraction of their current price, 1/100th. And if you had invested with Elon Musk, even $100, I think I did the math, and you'd have $600,000 today if you'd invested with Elon Musk in Tesla in the early days. So there are stories of great wealth in the stock market, but the average return is only 10%, and it varies widely. I will often use 10% as a benchmark, but here's the reality. For you to actually get a 10% return from the stock market over the long haul, you have to invest perfectly. You can never make a mistake. You can never pay a fee, right? The data that drives this indication that the stock market delivers 10% returns factors in no fees, not one penny of fees. Furthermore, it assumes that you stay in the market every day, that you have a long-term buy and hold conviction. And no matter how much the stock market goes down, you stay in. No matter how much it goes up, you stay in. And thick and thin. Here's the reality. We're human beings. And sometimes we do really dumb things. Sometimes we buy stock with excitement at the top and watch it go down. Sometimes we sell things at the bottom and then watch them go up after we've sold them. Let me give you an example. One guy I know was managing money for his family, his mother's estate, really, while she was still alive. And he put some money into a chicken restaurant chain. This is back in the early 2000s. High-flying stock. And so I think he bought shares at $35 a share. And then it went down to about half that. And so he'd put, I think, too much of the family's money in that one stock. So he put in probably 10 or 20% of the assets into that one stock, and it dropped in half. So if the stock was a good buy at 35, it's a better buy at 17. So he put more money in, and then it dropped in half again. And then he said, if it was a good buy at 17, boy, at 8, it's a screaming good deal. Put more money in. And he kept this up, and it kept going down until it filed bankruptcy and the stock became worthless. And so he had invested a big, fat chunk of the family money in this one bankrupt stock and got zero for it. So it's easy. It is easy for an individual to make bad decisions. And if you want to avoid bad decisions, you hire professionals, but professionals don't work for free. Then you got fees. So let's be clear. I'm going to often talk about 10% being a benchmark, right, against which we judge investments in impact crowdfunding. But the reality is, if you're trying to be an investor in that arena, it's hard to beat 9% over the long haul. And many of us, active investors, are getting closer to 5 and 6% returns in the stock market because of either layered fees upon fees or mistakes or a combination of the two. So it's really quite difficult to get the 10%. Most of us don't. I will use 10% in the discussion today and elsewhere, but be aware, I'm being generous to the stock market and assuming in this discussion implicitly that you are a perfect investor. If you're not, if you're like me and you're not a perfect investor, really the benchmark is probably closer to 6 or 8% than 10. Okay. So now we've got a sense of benchmark that's reasonable and rational, so we can move on and talk about this. Let me just talk briefly about what is impact. So when we talk about impact, we're talking about a change that results from your investment. Of course, in the impact investing community, when we talk about this, we're talking about the positive changes. That's what we're going for. The intention is to create positive change in the world. Everyone who's an investor in impact defines that and prioritizes it differently. Don't be too hung up about what's important to you. You may be very concerned about supporting veterans and fighting poverty, while others are more interested in climate change and social justice. And that's okay, right? You let them do them, you do you. Now, let me give you some examples. Impact could include reducing carbon. It could be improving public health. And it could be improving greater prosperity for other people, fighting poverty or social justice, right? So lots of opportunities for impact. And there are lots of opportunities to do this in the investment crowdfunding space. When we talk about investment crowdfunding, of course, we're not talking about GoFundMe, right? That's something else. Regulated investment crowdfunding is regulated by FINRA and the Securities and Exchange Commission. This is a heavily regulated marketplace. It doesn't mean everything goes up. Of course, that doesn't mean that. But let's be clear, because of the regulatory scrutiny, there's not a lot of fraud going on. Is there fraud? Yeah, there's some fraud. Very little, right? Think about it's just like the stock market. Was there fraud at WorldCom? Yes. Was there fraud at Enron? Yes. But these are rare stories in the pantheon of the stock market. Those are rare stories, and it's the same in regulated investment crowdfunding. Very little. And so billions of dollars have been raised. Hundreds of millions of dollars will be raised in this market this year. At least 1 million people have participated as investors. You are not the first. Join the club, join the crowd. We want to see you participating with us. Okay. So I like to think of impact crowdfunding as at the intersection of impact investing and impact crowdfunding, investment crowdfunding and impact investing. Impact investing was traditionally an area where only rich people played. And I am so excited that investment crowdfunding makes this marketplace open to ordinary investors. I don't care how you earn your living and how much you make, you can do some of this investing. That you can invest with as little as $10. So let's be clear, you don't have to be rich to play in this space. This is for ordinary people, ordinary investors. So there are 3 investment strategies that will allow you to match or beat the stock market return. Got to take into account some risk factors and things, but we can get a return that is comparable to or better than the stock market with impact crowdfunding using 3 different strategies. Let me talk about the first. So we'll talk about yield, a venture capital strategy and a hybrid strategy. Stay with me. Let's talk about yield first. Yield is a reference to the idea of getting interest or dividends on your money. And so when I talk about a yield strategy, I'm always talking about interest payments, not dividends. And we'll talk a little bit more about why in a minute. But the idea here is to invest in loans to small businesses, typically small business. It could be startups, but typically startups are raising equity. Small businesses are often raising debt. So they raise debt capital, they borrow money from the crowd and pay it back over time, like you pay back a car loan or a mortgage. Typically more like the car loan in terms of term, typically short terms, 3 to 5 years, 2 to 5 years. So you can get good interest rates, just like a CD, but much higher returns. It's higher risk than a CD, but higher returns. So there are two different approaches to this strategy that you could use. I'll walk you through how you could do each one. We'll call one hobby mode and the other one maven mode, right? Maven is the expert mode. So in hobby mode, what I would suggest is that you invest monthly. Now, this could be any amount of money from starting with $10, and it could go up from there. If your income and balance sheet supports it, put $1,000 in every month, put $2,000 in every, whatever you want, but monthly put in a little bit. And in hobby mode, you're probably going to make this small. So I'll use $100 as an example, but if that's a lot of money for you, and don't be ashamed, think of it as $10 or $20. You can do that. I want to encourage you then to look only at debt deals with relatively short maturities, 24, 36, maybe 48 months occasionally. And then look for interest rates near or above 10%. And it's easy to, all the borrowers who are borrowing money, the small businesses borrowing money out there are doing it with really clear terms. It is not hard to figure out what the interest rate is on a loan. It's always, in my experience, right up front. And so you know what your return is going to be. And it is not hard to find opportunities to invest. Right now, there are opportunities to invest up to 14% in stated interest rates, right? So getting near or above 10% is not hard. In the last 5 months, I think I've made 10 different investments in loans, in small business loans at rates from 8 to 12.75%, 8 to 12.75%. And I've made 10 different investments in that time frame. So keep it 24 to 36 months. And what will happen is after you've been investing monthly for about 24 to 36 months in 24 to 36 month loans, guess what? The money you get back from those loans will quickly become sufficient to keep funding your monthly investment perpetually. Now, it's not going to grow very much because you're just recycling the money. But here's the thing. You can keep doing this. You can keep having impact forever with this hobby mode strategy, just recycling what would be a few $1,000s if you're doing $100 a month. It could be hundreds of dollars if you just do $10 or $20 a month. It could be many thousands if you use more. So anyway, it becomes just a self-funding way to do your impact investing in hobby mode. Okay. Now, Maven mode. Here we use essentially the same approach, except that instead of stopping putting your earned income into this fund after a while, you continue to keep putting in a little bit of your earned income every month into this program that you might operate in your own setup at home. And if you do this for putting in $100 a month for 2 years, that's $2,400 you will have invested. You should have value of about $2,644 if you keep reinvesting all of the proceeds along with the new money you're investing yourself. Okay, so 2,644 after investing 2,400, not very exciting. You made $244. Okay, I'm not excited about that. You're not excited about that. What's the big deal? If you keep doing this for 10 years, you'll have $20,484. Yeah, but how much did you put in? If you put in $100 a month for 10 years, that's $12,000. So you've made $8,000 in that account, almost as much as you put in, you've now earned in interest. And it's comparable. It's the same rate you could get in the stock market, right? And you've made $8,000. That's starting to be real money. Now you do this for 30 years. So if you're 40 or younger, this could be a significant part of your you do this for 30 years and you'll have put in $36,000, but you'll have $226,000 in these accounts. $226,000. So that's $196,000 or $190,000 of profit that you'll have made over this. Now, I'm ignoring taxes. We got to deal with that. But presume for the sake of discussion, this was in a tax protected account like an IRA or something. So there you go. This is a cool deal. You can meet or beat stock market returns lending money to small businesses. Now, I want to be clear. Some will slow pay. Some will fail to pay you back everything. It will be unusual for someone not to pay everything back, but it will happen. And over 30 years, I expect that once or twice you'll invest $100 into a deal where the company never pays you a dime. It'll probably happen. Something went horribly wrong and they never made a payment. Again, I expect that to be rare, but over 30 years, I'd expect that to happen a time or two. But more likely, along the way, you'll see some people pay slowly. They'll get behind on their payments, and other people will eventually quit paying altogether. But on average, you should, using this strategy, be able to get a 10% return over the long haul or something very close to that. And you'd have to say, that risk is not too different from the stock market in that much more predictable. And you say, what about liquidity? I can't sell it instantly. No, you can't sell it instantly. But if you stop reinvesting the money that comes in every month in 24 to 36 months, if you're keeping this in relatively short-term notes, you've got all the money back. So it comes back pretty quickly. It's remarkably liquid. So anyway, there we go. That's the strategy for the yield strategy. And you can see how with a risk that could be comparable to, or maybe even a little lower than the stock market, you could match or even beat stock market returns, especially if you're being realistic about what you could earn in the stock market after fees and mistakes. Okay, let's talk about the second strategy, a venture capital strategy. First off, let's talk about what is venture capital. I think sometimes people misunderstand a little bit, envisioning venture capital as being a rich guy putting his money in startups. And it really isn't that. It's typically affluent people, sometimes rich people, managing other people's money. So these are funds where a general partner puts in a little bit of his or her own money, and then they gather money from genuinely wealthy investors who don't want to have to do the work of managing the investment. So they manage this for other people, and they charge really big fees. They typically charge 2% per year plus 20% of the profits. But some of the most successful, consistent winners charge even higher fees. The returns vary widely. It's huge, and it depends on the year, the vintage, as it's known in the venture capital industry, right? Because sometimes you get the opportunity to invest in a recession and harvest in a really strong economy. Boy, those are good vintages to be in, and the returns are above average. But if you are investing at the top of the market and harvesting in a recessionary period, you may be at the opposite. So returns vary, just like in the stock market. And the bottom performing funds often fail to return all the capital. I don't mean to suggest that they don't return any capital. Typically, they return a lot, most, but they don't return even 100%, right? Maybe they return 90% or 95%. So investors don't even get their money back, let alone any return on it. So it's a risky investment strategy, and smart people only put a little bit of their money, a little bit of their wealth into a venture capital strategy. But on average, even after paying the big fees, investors are getting about a 15% return. So the returns are good. But let's be clear, if you're an ordinary investor, there is no way for you to invest in venture funds directly. You are not allowed for a variety of reasons. If you're an ordinary investor, you cannot do it. So this isn't an option for you in the traditional venture capital marketplace. If you want to do this strategy, you have to use investment crowdfund. When we're talking about a venture capital strategy, instead of getting a return from interest on notes, we're investing in equity instruments that will appreciate, right? So this might be a common one is simple agreements for future equity. Another common one is convertible notes. These are notes that have an interest rate on them, but they convert into equity and almost never actually pay interest payments or pay out the cash. They convert to equity, and then you end up owning a chunk of the business. Could also be a direct purchase of common or preferred stock. Any of those options is possible in the impact crowdfunding marketplace. And so you can pick kind of your stage of investment to some extent. We have to be a little bit honest here that in the crowdfunding marketplace, there is not a robust collection of successful follow-on funding rounds being done in the crowdfunding marketplace. There is a little bit of that. But if you wanted to do only later stage deals, you'd have to be patient, watching for those to come along. Now, I'm hoping that will improve, and there's some evidence that could happen. I certainly hope it will. So with a venture capital strategy, you have to understand this is a long-term investment horizon. Venture capitalists, when they invest, typically are investing for 7 to 10 years. Now, their target is to get out faster than that, but their documents allow them to hold the money typically for 7 to 10 years. They may stop taking fees after a part of that and just hold some of the investments that are difficult to liquidate for a while after their fees expire. But in any case, it's a long-term horizon. And as crowdfund investors, on average, we're probably investing at an earlier stage than the professional venture capital funds. So that tends to mean we may have to be even more patient. So maybe we should be thinking about 8 to 12 years when we make venture capital style or venture capital strategy investments. Here's one of the realities. Most of the deals you invest in will deliver $0. Let me say that again. Most of the investments you make in this strategy will deliver $0. Zero. Why is that? A lot of startups that you would invest in have little or no revenue at the time you invest. They may be years from developing a marketplace, and they may never be able to do it. They may have great potential. You may be really excited about that potential, but if they can't realize that potential, they deliver nothing. But here's the thing. When a company does perform, when it does deliver, it could deliver big. It could deliver tenfold. It could deliver 20-fold. It could deliver 100-fold. Now, that won't happen often. 100-fold, over 30 years, you might see one or two of those, right? It'll be rare. Tenfold, you've got to count on a lot of those 10 baggers, as they're known in the venture capital and startup community. You got to have some. You got to count on 10 baggers. So diversification is critical. You've got to build a portfolio of these investments. If you think you're using a venture capital strategy, but you put all of your money in one deal, you are not using the venture capital strategy. You are just gambling. That's all you're doing. You're just gambling. So again, I said at the beginning of our discussion around venture capital that smart people don't put all of their money in it. Don't put all of your money in this strategy, even though this strategy has the highest return potential. It has the highest risk. It has the biggest chance of you failing to meet or beat the stock market, and potentially even losing most of your money. You've got to be really careful. So put only a portion, I would say a small portion of your money in this strategy. But you could see, as a complement to some of your other investments, this could be a fun, exciting way to try to beat the stock market. And it has that genuine potential. No guarantees, right? There are no guarantees in this space, but there is the genuine potential. Let's talk a little bit about the third strategy, the hybrid strategy. And I call it hybrid, but it's really, we'll talk about this. It's not just yield and venture capital together. It's really a three-legged stool. So hybrid may not be a great name for it, but we're bringing together those two fundamental strategies and balancing them, because we've established, I think, that the lending to small businesses marketplace, that strategy has risk comparable to or maybe lower than the stock market and can match the returns of the stock market. Given that could be a meaningful chunk of your portfolio. Your venture capital strategy could be another piece. I would recommend that it be smaller. Now, if you're very young, it can be a little bit bigger. If you're under 40, it can be a little bit bigger. But after your 40th birthday, I encourage you to start building more on the debt side so that you're reducing your risk as you increase your wealth and approach retirement. But there's a third leg to the stool, and it is revenue-based financing investments. And let me describe these. The revenue-based financing investments are loans without a stated interest rate. Instead, the borrower promises to return a multiple of your money. Typically, it's around 2, sometimes as much as 3 or 4, sometimes as little as 1.5. That's potentially a reasonable deal, right? Depends on the maturity of the company and its prospects for actually delivering revenue. If a company has revenue today and you do a revenue-based financing, that's not nearly as risky as a startup that promises this and it doesn't have any revenue today. So you could invest in either type, but you could invest in startups using revenue-based financing, but you'd want to get a multiple of 3 or 4 instead of 1.5 or 2 if they don't have revenue yet. And you say, don't I want tenfold from my startup investments? Here's the thing. Using a revenue-based financing approach, that business is reducing your risk as an investor pretty significantly. Most startups will get to revenue. They may not get to profits. They may not be able to be super valuable, but if they can start generating revenue, they can start paying you back. So you get at least some of your money back, maybe all of it, maybe not the full 2x, 3x, 4x. But if you get some of your money back, all of your money back, and then some, you're doing a lot better than if you made an equity investment and that company never has a liquidity event that allows you to get your money back. It's reasonable and possible to build a portfolio of revenue-based financing loans that yield better than 10%, and so would have a risk-adjusted return that's like the stock market, maybe a little bit riskier depending on how you build it, whether you focus on pre-revenue companies or post companies that already have revenue and profits. So you build your portfolio. But that as an added aspect of the hybrid strategy is much less risky than the venture capital strategy, and of course has a higher return potential. Won't guarantee higher returns, but it has a higher return potential than just the yield strategy. And quite frankly, most people who are active in the investment crowdfunding marketplace, the impact crowdfunding marketplace, most of us are using implicitly or explicitly a hybrid strategy where we're looking across the spectrum of investments and considering a range of things across the spectrum. Okay. Now, I want to add let me invite you to submit your questions now, but I want to just take a minute as we wrap up to highlight that there are two key things we did not talk about at length today that you need to keep in mind. And this idea, these strategies only work if you deploy both of these features. We talked a little bit about diversification. Diversification is absolutely essential. You've got to make many investments, and you should think of your impact crowdfunding investments as probably a small part of your total asset portfolio or your total asset mix. This shouldn't be 100% of your assets for anybody. If you'd like to do that, I really strongly encourage you to get a financial advisor who loves this stuff as much as I do and can help you with it. And I can give you names if you want names. I'll do that offline. Just email me, devin@thesupercrowd.com. The second key thing is due diligence. You've got to learn to research your investments before you make them. One great way to do that is with the help of other people. Join an investment club like the Impact Cherubs, and we're open, always looking for new members. Visit impactcherub.com to learn more about that. But you've got to do due diligence. You've got to analyze that. I also post a pick of the week with a lengthy diligence report every Friday to our paying subscribers, our impact members of the Super Crowd. Visit s4g.biz to learn more about that. Okay, I'm going to look for an opportunity to do questions. Any questions quickly? I will take it as a compliment if there are no questions, because that would suggest that I answered everything perfectly in the presentation. I'll give you a minute. If you are trying to form a question, feel free to submit that using the Q&A function. That's the question mark button at the bottom of your Zoom window. Any questions? Okay, listen, we'll be back again next month. We do these SuperCrowdHour webinars on the third Wednesday of each month at 1 Eastern, 10 Pacific. I love seeing you here. I'm grateful that you would come, and look forward to continuing this tradition. And next month, we'll focus on some strategies for crowdfunders on raising capital. We'll be talking about how to assess your community and your network and your potential for crowdfunding. That's what we'll talk about next month. So we'll look forward to seeing you then. Thanks, everybody.